Hi, welcome to the second part of Make Your First Trade Day 1. I'm Tressa Stanley, and we are going to go ahead and get right into this lesson. What is Forex? Forex is the foreign currency market, and in this market, $5.3 trillion per day are traded. Excuse me. The major market participants that affect this market and trade in this market are the government and central banks, the financial institutions, the brokers, which include the hedgers and speculators, and then at the very bottom of the barrel are us, the retail investors. But we're talking about $5.3 trillion per day is traded there. So there are plenty of crumbs available for us as retail investors to benefit from in the Forex market. Now, the most heavily traded currencies are your US dollar, your euro, Japanese yen, British pound, Australian dollar, Swiss franc, and Canadian dollar. Major currency pairs are any of the most heavily traded that are paired with the US dollar. Those are the ones that we just went over on the previous screen. Your minor and your cross pairs, those are any of the heavily most traded that are not paired with the US dollar, but they're paired with the British pound, Australian dollar, Canadian dollar, or Japanese yen. Then your exotic pairs are emerging economies that are paired with the US dollar. Things like you'll see USD ZAR. The USD ZAR would be South African Rand. Those exotic pairs cost the most to trade. Your major currency pairs are going to have your lowest spreads, and your minor and cross pairs will be in the middle. The top 8 pairs to trade are the Euro USD, the USD JPY, the GBP USD, Australian dollar US dollar, USD CAD, USD CHF, Euro JPY, Euro British pound. Now, under that, you'll see some have the little 2-letter references. Sometimes in the chat, they won't list out the entire pair. They'll list the first letter of each currency that's in the pair. Now, when is the best time to trade Forex? Well, let's first start with the cost, because you want to make sure that your costs are cheaper. So you've heard me refer to a spread. The spread is the difference between the buying and the selling price of the currency pair. It's what the broker charges for the trade. So I have 2 examples listed here. If you look to the far right, you'll see the symbols listed, starting with the Australian dollar, Canadian dollar. You'll see a bid and an ask price. When you enter a trade, if you're entering it as a buy, you're entering it at the bid price. The bid price is going to be the lower of the 2. If you are entering it as a sell, that means you're anticipating that the value is going to go down. You're entering it at the ask price, which is the higher of the 2. In the second example, you'll see where it says to the right, you'll see quotes, and below that you'll see AUD, JPY, and you'll see spread, 123 pips. The buying price or the ask price is 87.98 because it is the lower of the 2. So the difference between the values is what is charged for the broker. That's how they make their money. So you enter it at the lower price if you are buying. If you are selling, again, anticipating the price to go down, then you are entering it at the ask or selling price, which is 88.103. Volatility. Volatility is simply the movement and speed of the market. It's just simply the movement and speed of the market. It does not imply direction. Volatility can mean that it's going up and down rapidly in one direction, or it can go up and down in the other direction, or it just may be going up and down sideways. So volatility does not imply direction. It describes the level of fluctuations, the level of moves of the exchange rate. Excuse me. A currency pair that's more volatile is likely to increase or decrease in value more than one that's less volatile. You want to stay out of the markets during low volatility times. And the reason why is because if it's not moving too fast, then there's just no money there to be made. Liquidity. Liquidity is how many market participants are active. Now, we went through the list of market participants. Remember, I said we, the retail investors, are way down at the bottom of the barrel. So we're not the ones who determine whether the market is really liquid when we're active. It's really high liquidity times when the major banks are active, when the hedgers and speculators and the brokers are active. So that is when we want to be trading. We want to trade when the big boys trade. That means that the market is highly liquid. Volume. We want to trade during times that high volumes are being traded. So again, that is when the big boys are trading. The big boys don't trade on the major holidays. The banks are closed, therefore their employees are off and they're not trading. The brokers are closed. The hedgers and speculators are spending time with their families. So that's what we should be doing during that time. Spending time with our families, enjoying the fruits of our labor, and staying out of the market on major holidays. The volume is highest during the session overlaps time. When sessions are overlapping, you want to enter the market. During low volume times, which are holidays, the end of the London session, beginning of the Sydney session, stay out of the market. It's not the time to trade. Now, you've heard me mention the sessions. I'm going to go through these really quickly. The Sydney session kicks off our Forex day. It's the smallest of all the sessions. It's the most calm of the markets. You're going to have higher spreads, low volatility, low volume, low liquidity. So, this is not the best time to trade. This is a great time to plan. So the major pairs that are traded are anything that's traded with the Australian dollar and the New Zealand dollar. The next session to follow Sydney is the Tokyo session. The Sydney and the Tokyo together make up the Asian session. The Tokyo session is the third largest trading session. Low liquidity, low volume, higher spreads. It's also a good time to plan. The Japanese yen is traded at higher volumes. If you are going to get into this session, you want to get into it at a time when the London session is overlapping it. The London session is the largest trading session. This is where it's the best time to trade. You'll hear a lot of people talking about the London session in this company. High volatility, high volume, low spreads, and it's the best time to trade. The GBP, the British pound, the euro, and the Swiss franc are the most heavily traded currencies during this session. And what closes out our day is the New York session. The New York session is the second largest trading session. This is where you see the big moves happen in the early part of the session, and that's because the European news has already come out and major news releases are happening right here in the U.S. Volatility dies afternoon. It's a high volume time, high volatility time, very low spreads, great time to trade. 85% of the trades are the US dollar, and the Canadian dollar is also heavily traded. The best times to trade will be when major sessions overlap. Again, we talked about the largest and number two sessions are London and New York. So, of course, trading during the overlap of London and New York is the absolute best time to trade, as long as it's not a holiday. The crossover of the London session and Tokyo session are also good times to trade. And what I find is around that time is when I'm starting to get real good swipes that are for the London session that are coming out right as the Tokyo session is ending. The absolute worst times to trade: afternoon Eastern Standard Time. The London session has gone away and pretty much everything dies on the Forex market. You don't want to trade at the start of the Sydney session. That's also, it's a little putt-putt. Very slow during that time. The beginning of the Tokyo session, the same, when there are no sessions overlapping, and major holidays, especially US and European banking holidays. You also want to not enter a particular trade when there's a whole lot of consolidation going on. And consolidation, we're getting ready